What if the single biggest obstacle to building wealth wasn't a lack of information, but an abundance of it? Every day, you're bombarded. Buy this stock. Sell that crypto. This sector is hot. That one is not. It's a full-time job just to keep up, a constant state of anxiety, chasing the next big thing while fearing the next big crash. The entire financial world seems built on a single premise. That complexity is the key to success. That you need to be smarter, faster, and more informed than everyone else. But what if that's a lie? A carefully constructed myth designed to keep you trading, paying fees, and feeling like you're always one step behind. In this video, we're going to deconstruct the system that thrives on your anxiety. We will expose the paradox that hides in plain sight, that the most effective investment strategy might also be the laziest. We're going to break down a simple, two-asset protocol that 99% of investors miss, not because it's a secret, but because it's too simple to believe. And by the end, you'll understand not just what it is, but the deep psychological reasons why it works when almost everything else fails. Most people who start investing are handed the same playbook. It says you need to be diversified. This word, diversification, is often misunderstood. It doesn't just mean not putting all your eggs in one basket. It's been interpreted as needing a dozen different baskets. You're told to buy some big tech stocks like Apple and Amazon, maybe a few dividend-paying companies, an international fund, perhaps some real estate, and of course, a little bit of crypto just in case. Your portfolio ends up looking like a complex machine with 100 moving parts, each one requiring your constant attention. The financial news reinforces this every single day. We see headlines about the one stock that surged 1,000% or the crypto millionaire who got in early. These stories are the proof, the evidence that constant vigilance and brilliant stock picking are the path to riches. The game as it's presented is about finding the needle in the haystack. But what if the game is rigged? What if by trying to find the needle, you're ignoring the value of the entire haystack? If this strategy is so effective, why do study after study show that the vast majority of active fund managers, the professionals, fail to even match the market's average return over the long run? There's a crack in the foundation of this common wisdom. The constant activity, the endless search for the next winner. What if that isn't the strategy? What if that's the trap? To understand why, we need to introduce a simple but powerful mental model. The concept of signal versus noise. Imagine you're driving a ship across the ocean. The signal is the true direction, the underlying current that is slowly but surely taking you to your destination. The noise is everything else, the individual waves crashing against the hull, the shifting winds, the stormy weather. In the world of investing, the signal is the long-term, upward trend of the global economy. For over a century, despite wars, pandemics, and depressions, the market has consistently grown as human innovation and productivity increase. That's the powerful current. The noise is the daily news cycle, the earnings reports, the inflation numbers, the political drama, the expert predictions. Now let's look at a chart of the S&P 500 over the last 50 years. From a distance, it's an undeniable upward slope. That's the signal. But when you zoom in, you see the terrifying drops of 1987, 2000, and 2008. That's the noise. The complex strategy of picking individual stocks is an attempt to expertly navigate the waves, to predict the noise. But the far simpler strategy is to just own the entire market, to buy a simple low-cost index fund, and let the underlying current do all the work. The first aha moment is this. Your goal isn't to outsmart the noise, it's to capture the signal with as little effort and cost as possible. But if it's that simple, why doesn't everyone just buy one index fund and call it a day? Because this strategy has a catastrophic flaw, one that has nothing to do with finance and everything to do with human psychology. Let's say you followed this advice in 1999. You put your life savings into an S&P 500 index fund. Then, the dot-com bubble bursts. Over the next 2 years, you watch your portfolio get cut nearly in half. Or maybe you started in 2007. The global financial crisis hits, and your nest egg plummets over 50%. At that moment, the signal is impossible to see. All you hear is the noise, the deafening roar of the storm. Every expert on TV is screaming that the world is ending. Your friends are selling. Your gut, your primal instinct for survival, is screaming at you to get out before you lose everything. And so, you do. You sell at the absolute bottom, turning a temporary paper loss into a permanent, devastating financial reality. The 100% stock market strategy fails not because the signal is weak, but because our minds are too weak to endure the noise. This is the great paradox. The optimal mathematical strategy is psychologically unlivable for most human beings.
So if owning the market alone provides the growth but sets us up for psychological failure, what is the missing piece? What tool can we use to protect us from our own worst instincts when the storm hits? To answer that, we have to look beyond growth and start thinking about defense. This isn't just about numbers on a screen. This is about the visceral, gut-wrenching fear of losing your future, of seeing the money you saved for your children's education or your own retirement vanish in a matter of months.
That fear is real, and it's the most powerful force in investing. Any strategy that ignores it is doomed to fail. To counteract it, you don't need a more complicated offense. You need a simple, unshakable defense. Think of it like this. The stock market is the engine of your ship, powerfully pushing you forward. But an engine alone is useless in a hurricane. You also need an anchor, something heavy, stable, and boring that you can drop when the waves get too high, keeping your ship from being smashed against the rocks. For centuries, the financial anchor has been bonds, specifically high-quality government bonds. They are the polar opposite of stocks. They don't offer exciting growth, but they offer stability. When the world is panicking and selling stocks, they are often buying the safety of bonds. But I know what you're thinking. Bonds, in today's world? Their returns are pathetic, sometimes not even keeping up with inflation. It feels like you're actively losing money. Why would I ever dilute my high-growth stocks with this dead weight? That argument seems to refute this entire protocol. It's the single biggest reason people abandon this strategy. But this is where we have to deconstruct the virtue of bonds. We're judging them by the wrong metric. You don't measure the performance of an anchor by how fast it moves. You measure it by how well it holds. The job of bonds in your portfolio is not to generate wealth. Their job is to manage your fear. When your stocks are down 50%, your bonds are likely stable or even slightly up. This does two critical things. First, it cushions the fall, making the overall drop in your portfolio far less terrifying. Second, and more importantly, it gives you a source of stable capital you can use to rebalance. To sell some of your stable bonds and buy stocks at a massive discount. In other words, the anchor transforms you from a panicked seller into a disciplined, opportunistic buyer. Your bonds' greatest weakness, their low volatility and boring stability, is actually their most powerful psychological and strategic strength. Even their worst performance is better than the emotional catastrophe of selling your stocks at the bottom. So here is the complete picture. The two assets are not just stocks and bonds, they are the engine and the anchor. Asset 1, a low-cost total market stock index fund, is your engine. Its purpose is to capture the powerful, long-term signal of global economic growth. Asset 2, a low-cost, high-quality bond index fund, is your anchor. Its purpose is to stabilize the ship during the inevitable storms of market noise, protecting you from your own panic. The investor who only owns stocks has a powerful engine but no anchor, destined to capsize in the first major storm. The investor who only owns bonds has a mighty anchor but no engine, destined to go nowhere, slowly eroded by the tides of inflation. The magic is in owning both. The point of failure for nearly every investor is the same. The moment the market crashes and fear overwhelms reason. It's the moment they abandon their plan. This two-asset protocol is designed with a single purpose, to get you through that exact moment. Now that we understand the what and the why, the only question left is the how. What is the simple, automated rule that ties this all together, the one that turns chaos into opportunity and allows you to execute this strategy without thinking? The answer is the final piece of the puzzle, and it's what truly makes this the lazy protocol.